What if I told you those dividend checks you love to brag about, the ones that feel like a steady stream of passive income, are actually just a cleverly disguised trap, quietly bleeding your retirement dry, one seemingly innocent payout at a time? Most people think dividend stocks are the ultimate safe haven, a cozy corner where your money can grow without a care in the world. But what if I told you this narrative is a dangerous fantasy? What if those reliable dividend payments are actually warning signs that you're about to lose everything? The truth is that dividend investing can be a great addition to anyone's portfolio, if you do it right. But if you're still clinging to the 3 pervasive lies I'm about to expose, that supposedly rock-solid income stream can vanish overnight. Worse, it can take a significant chunk of your hard-earned capital right along with it. Wall Street loves dividend investors because they're predictable. They chase yields like moths to a flame. They rarely question the sustainability of those payments, and they hold on to losing positions far longer than they should because, hey, at least I'm getting paid while I wait. But today, we're ripping the wrapping paper off these myths and tearing through the marketing fluff to reveal the raw, often uncomfortable truth. Because once you truly understand these 3 biggest lies, I promise, you'll never look at a supposedly juicy dividend yield the same way again. Lie number 1. Dividend stocks are a safe haven. This is perhaps the biggest, warmest blanket Wall Street loves to wrap around retirees and conservative investors. They'll gently steer you towards household names like Procter & Gamble, Coca-Cola, or any company that boasts a 50-year payment history, whispering sweet nothings like, "They've always paid, they always will." It's a wonderful, comforting story, isn't it? A narrative built on decades of perceived reliability. But comfort can be a dangerous illusion in the market. You need to open the hood, kick the tires, and look beyond the glossy brochure. Let's talk about Walgreens. For decades, Walgreens was a bona fide dividend aristocrat, consistently raising its payouts for over 4 straight decades. 40 years. That's an impressive streak. A testament to stability, right? Not so fast. In early 2024, the board had to face reality. Their yield was too high. They slashed the dividend by 48%. Predictably, the market reacted brutally. The share price cratered a staggering 35% in just 6 weeks. So much for a safe haven, more like a sinkhole that swallowed a lot of retirement dreams. But here's what really gets me fired up about this. It wasn't some black swan event or unforeseeable catastrophe that destroyed Walgreens' dividend. The warning signs were there for anyone who bothered to look. The payout ratio was unsustainable. The free cash flow couldn't support the dividend. The business was struggling. Yet investors kept holding because of that magical 40-year streak, as if past performance could somehow defy the laws of mathematics and business reality. This is the core problem with the safe haven narrative. People become so seduced by history that they ignore present-day fundamentals. They develop what I call dividend blindness, an inability to see the red flags waving right in front of them. Safety in dividend investing isn't about how many years a company has been paying. It's about cold, hard balance sheet math. It's about the underlying financial health of the business. You need 2 quick, non-negotiable checks before you even think about buying a dividend stock. First, a payout ratio below 70%. This tells you if the company is earning enough to cover its dividend payments comfortably. If they're paying out more than they earn, it's a ticking time bomb. Simple math. If you're paying out 90% of what you make, there's no flexibility, no room for error. Second, free cash flow coverage above 1.3x. This is even more crucial than the payout ratio. Free cash flow is the actual cash a business generates after all its expenses and capital expenditures. It's the real money available to pay dividends. If they don't have enough free cash flow to cover their dividend, they're either borrowing money or selling assets to maintain the payout. That's a red flag waving furiously in hurricane-force winds. Miss either of these critical tests, and that dividend, no matter how long its history, is living on borrowed time. And don't think only struggling companies fall into this trap. Rising rates can crush the valuations and cash flows of traditionally safe dividend payers almost overnight. So the next time a broker or an online guru brags about a 20 or 30-year dividend record, don't just nod along. Ask for the free cash flow coverage ratio. Ask for the payout ratio. Demand the real numbers, not just the shiny trophy case of past performance. True safety comes from robust fundamentals and a wide economic moat. not just a long history of payments. Lie number 2. Dividends are free money. This is perhaps the most seductive lie, the one that whispers sweet nothings like, "I get paid to wait." It sounds fantastic, doesn't it? You buy a stock, it goes up, and on top of that, you get a regular cash payment just for holding it. It feels like extra money appearing in your account out of thin air. The psychological appeal is undeniable. Who doesn't want to feel like their money is working for them? But here's the cold, hard truth. It's not free money, not even close. When a company pays a dividend, something very specific happens on what's called the ex-dividend date. On that day, the stock exchange automatically adjusts the stock price downward by roughly the exact amount of the payout. Let's say McDonald's announces a $1 dividend. On the ex-dividend date, the opening price of McDonald's stock will be $1 lighter, all else being equal. You're not suddenly $1 richer. You haven't gained anything new. What you've done is simply converted a portion of your equity, your ownership in the company, into cash. Your overall net worth doesn't jump. It just shifts from one pocket to another. You owned a piece of the company, and now you own a slightly smaller piece, with the difference paid to you in cash. It's a return of capital, not necessarily a return on capital in the way most people perceive it. Academics have a name for this pervasive misunderstanding. They call it the dividend fallacy. And behavioral studies have consistently shown that investors who mentally double count the payout tend to take on significantly more risk. Why? Because they feel like they have this extra cushion of free money, which makes them more complacent about the underlying health of their investment. This psychological trap can lead to poor decision-making, like holding on to struggling companies longer than they should, or chasing unsustainable yields because they're getting regular dividend payment dopamine hits. Instead of chasing these perceived bonus points, your only focus should be on total return. The price appreciation of your stock plus any dividends received minus any taxes and trading costs. That's the real measure of your investment success. Consider this. A stock that pays a modest 3% dividend but consistently grows its earnings by 20% a year will absolutely wallop a 10% yielder whose underlying business is stagnant or shrinking. The market doesn't forget. Ultimately, genuine capital growth driven by a thriving business trumps those seemingly attractive coupons every single time. Don't fall for the illusion of free money. Focus on the true engine of wealth creation. Lie number 3. Higher yield equals higher return. The siren song of the double-digit yield. Nothing seduces income hunters quite like seeing a stock offering a 12, 15, or even 20% dividend yield. It feels like hitting the jackpot, doesn't it? Like finding a secret shortcut to massive returns. But here's the critical lesson you absolutely must understand. An oversized yield is almost always a smoke alarm, not a welcome mat. When a stock's yield spikes above, say, 8%, the odds are overwhelmingly high that the stock price has been absolutely nuked. The market, in its collective wisdom, isn't offering you a gift. It's betting very strongly that the dividend payout is about to be cut. It's a sign of distress, a clear indication that the underlying business is in deep trouble. This is what we call a dividend trap. Take Frontier Communications. Not too long ago, it boasted a tantalizing 12% dividend yield. Investors flocked to it, dreaming of that incredible income stream. But those dreams turned into a nightmare when Frontier filed for Chapter 11 bankruptcy. Shareholders were wiped out. That 12% dividend wasn't income. It was a slow return of capital before the entire house of cards collapsed. The company was effectively paying you back your own money, bit by bit, as it spiraled towards insolvency. Or consider the energy sector during the oil crash of 2020. Companies like Suncor Energy were offering yields that seemed too good to be true, because they were. When oil prices collapsed, Suncor slashed its dividend by 55% and its stock price followed suit. Investors didn't just lose their dividend income, they lost massive amounts of capital as well. So, how do you spot the trap before it snaps shut? First, compare the yield to its peer median. If a company's dividend yield is double or triple what its closest competitors are offering, that's your first major red flag. It's a signal to stop, pause, and dig much, much deeper. Ask yourself why this company is such an outlier. Is it genuinely undervalued, or is the market pricing in an imminent dividend cut? Second, check the trailing 12-month payout ratio against free cash flow. If that payout ratio is consistently over 85%, you need to recognize that's not sustainable. It means the company is straining to maintain that payout, leaving little room for error or reinvestment. It's an unsustainable path that leads to only one destination: dividend cuts and capital destruction. Third, glance at what's called distance to default, a sophisticated but incredibly useful metric that flags balance sheet stress and the probability of a company defaulting on its debt. Think of it as an early warning system for financial collapse. Anything under 2 on this scale is flashing bright red, signaling severe financial instability. A juicy yield coupled with shaky cash flow is like enthusiastically dating someone who's already secretly planning the breakup. You're just a temporary distraction from the inevitable demise? Don't be the last to know. If you want to build real wealth through dividend investing, here's what actually works. Focus on companies with sustainable competitive advantages, what Warren Buffett calls economic moats. These businesses can maintain pricing power and market share even during tough times, which protects their ability to pay and grow dividends. Look for consistent free cash flow generation, not just accounting earnings. Cash is what pays dividends, not earnings manipulated by accounting tricks. Seek out businesses with reasonable payout ratios that leave room for dividend growth. A company paying out 40% of its earnings has much more flexibility than one paying out 90%. Diversify across sectors and geographies. Don't put all your dividend eggs in one industry basket, no matter how safe it seems. And most importantly, remember that the best dividend stocks are often the ones with modest current yields but strong dividend growth prospects. A stock yielding 3% today that grows its dividend by 10% annually will eventually yield much more on your original investment than a stock yielding 6% today with no growth. The safest dividend isn't the one with the longest history or the highest yield. It's the one that's still there, consistently growing, when you actually need it most. If you found value in this video, hit that subscribe button. We publish fresh content weekly about practical, wealth-building strategies that actually work. See you on the next one.